Hello, everyone. Welcome to our quarterly Diamond Trends webinar. It's great to be with you again, and Happy New Year to you, or belated Happy New Year to you all. I hope you're all keeping healthy and well and warm. And it's great to try and understand what's going on in the market. It's not an easy market to understand. So I appreciate your time and in joining with us, and I look forward to our conversation. So the structure of today's webinar will be the same as we always do. I'm going to speak and present my slide presentation for about 45 minutes to an hour, and then we will open it up to some questions, and I'll do my best to answer any questions that you have. If you do have questions, you can put it in the chat or the Q&A icon on the Zoom application. So I'll do my best to answer those, but hopefully we'll get some clarity about what's going on in the diamond market at the moment. So if you see me tilting my head, if you focus on me and I'm tilting my head to the side, it's because I've got a second screen and I'm looking at that. But the goal of our webinar today is, firstly, we're going to look back at 2021, which was an excellent year for the trade, but we want to just get some understanding of what type of growth we actually did experience during the last year. And then we're going to spend the bulk of our time trying to understand the current polished market environment, which is not a simple one to understand. We're going to assess if there's any reason for caution. And then very briefly, we're going to identify the big editorial themes that we're looking out for on diamonds.net for 2022. So there's going to be a lot of graphs, as I tend to do. So put your graph goggles on, and let's enjoy this ride. So just a disclaimer to say that anything I present today is from our perspective. It's not a recommendation of any sort, whether in terms of investment or buying practice. So it's really just a presentation of how I and how we see the market. Secondly, a lot of the information comes out of our discussions at Rapaport on how we're seeing the market, and many of the ideas come from private conversations I have with Shimon Gerstensang, who is our head of pricing at Rapaport, and really a source of great insight for me. So I appreciate that, and I just want to give credit to Shimon for his help and appreciation for his help in understanding this market. So let's get started. When we look at 2021 and we look back at it, and everyone was all smiles, and rightly so, because it was really an excellent year for the industry, and that stemmed right through from consumer demand, and it filtered through retail, through wholesale, and the dealer market, and through to the mining sector. And so if we look at the value chain across the pipeline, we see that in 2021 there was growth across all sectors of the market, and that's including rough production, which by value grew by 12% year on year, through rough sales, where the growth was 59% year on year, and polished sales, we estimate were about 75% up on 2020. And then diamond jewelry retail, it's a ballpark estimate, and really based on what other people are saying as well, that it was probably at a growth rate of about 30% year on year. The more encouraging thing is that compared to 2 years ago, pre-pandemic, that the growth is there as well. Particularly, well, the growth is on the sales side of things. What's interesting, and it's a point that we'll pick up again a bit later in our discussion, is that rough production is still below pre-pandemic levels. And so that is something that I think is affecting the market. But in terms of our sales growth, rough sales, polished sales, jewelry sales, we are well above 2019 levels as well. Granted, 2019 wasn't the greatest year either for the diamond trade, but still, in terms of that growth trajectory and injection of positive sentiment to the market, it really is encouraging that and it was an almost unprecedented year in terms of those numbers, and long may it last. But and so that positive sentiment that really stemmed from the US consumer market, I would emphasize, really trickled down to the trade, and we saw good growth in terms of polished prices that for the year, by the end of December, for the full 12 months, we saw growth of about 17% in the 1 caraters, 18.7% for the year in the 3 caraters. The half caraters were slightly up by just 1% for the full year, and then the 30 pointers were slightly down for the full year, and that's in terms of the RAPI index. The RAPI index, remember, is the average of the top 10% of diamonds on RapNet, and the taking the average of the top 25 categories. So it's the D2H, IF, VS clarity goods. So that gives us an indication of that sort of trajectory that started in 2021, and that uptrend was a healthy one. It was a gradual one. If you look at the black line, which is the 1 caraters and really our sort of flagship RAPI index, the increases were fairly gradual through 2021. The horizontal line that I've put here marks the beginning of 22, and we've seen since in the last month and a half of 2022 that the increases have really increased in their rate, and we've seen some sharp spikes in diamond prices that continues today. I prepared this graph a day or two ago, and I updated it again today, and the increase was significant just in a day or two, particularly as you see in the 3 caraters and the 1 carat. In fact, in all categories, that increase is continuing on a day-to-day basis, and so that is generating some concern for people, and there's sort of 2 camps out there: those who believe that the increase is justified and will continue, and those who are concerned that there is some speculation in the market, and that we're kind of entering bubble territory. And so we are going to spend some time to pose that question: what is driving the increase? Are these increases justified or not? Looking at it from a historical basis, we published the Diamond Price Statistics Annual Report in our January issue, as we do every year. There it gives over 40 years worth of data that puts the year that was in perspective. And so 2021, we see this return to some growth that we haven't seen in the last decade. Since 2011, there has been a gradual decline in diamond prices. This left graph shows the Rapaport Diamond Index, which is an index following the Rapaport price list. And the graph on the right shows puts both the Rapaport price list against RapNet prices, and the gray line is that RAPI index, which is based on RapNet prices, and the top line of the red graph is the is the Rapaport price list or Rapaport Diamond Index. Anyway, just from a historic perspective, the increases seen from, say, the beginning, say, sort of late 2020 through 2021, are a reversal of the trends that we had seen in the previous decade. And so that is encouraging. But then as we now move into 2022, the increases have been exponential. And so we need to keep an eye on that and understand what's driving that. And so in this current quarter, we are seeing increases that we haven't seen in the last 10 years, since 2011, even preceding this graph, that as you see, so far in January, February, the 1 carat Rappi is up by over 10%. And we've had a number of quarters of consecutive growth, but this growth is really exceeding anything we've seen so far in this period of increases. And so the question is, will it continue? And so I'd like to hear from all of you to get your perspective on a very simple question. What are your expectations? Do you expect that polish prices will continue to increase in the first half, through the first half of this year? You can answer yes, no, or uncertain, or maybe. And so I'd love to hear your perspective. So if we can just activate that poll question. Anna is our production manager, who's helping with the technical aspects of this webinar. So thank you, Anna. And so I'll give it a few seconds to get the results and let you put in your answers there. And it's a tight race, folks. It's not a tight race. It's actually a runaway race, because at the moment we're looking at about 55% of you are saying that you do expect the polish prices to continue to rise through the first half. Only 8% of you say that they will not continue to rise, and 37% say that you are uncertain. So that's very interesting. I'll put that on the shared screen just to have a quick look and give you some idea of that. So that's quite interesting, and I think that there we go. I'll share the results. So I think when we look at the market mood, the part of the, in a way, that's the results of that little questionnaire don't surprise me too much. Actually, they do surprise me a little, because our audience today is mainly for the American market, and I was very interested to see what the results of that question would be, depending on who is answering. So today's webinar being catered from a time point of view to the American market, and then I repeat it tomorrow again for the Indian market. And I was actually expecting the Indian market to be more optimistic, or expecting that price increase to come from the supplier point of view. If I can assume that the US market is more on the buy side, which is a gross generalization, I know. Anyway, it's kind of interesting, and there is a lot of optimism out there in terms of the continuation of that price increase. And I think that sort of sums up the mood of the market at the moment. There's that old cliche of cautious optimism, but I think the market is optimistically cautious, if there is a difference between the two. But I would have expected a more mixed reaction to the uptrend, because I think there is some confusion regarding not that polished prices are increasing, but the rate of the increase that we're seeing. As I showed in the previous graphs, that in 2022 there's been the sudden spike, and that this first quarter that we're engulfed in at the moment is really showing strong increases in pricing that we haven't seen for some time. And so there's I think it's the rate of increase that is really injecting that caution to the market. There are different reactions, as I alluded to earlier, among different segments of the market. Dealers are struggling to buy at prices for which they're selling. So if a dealer is buying and selling and making a profit on that, it's their replacement that is very difficult for them at the moment. So dealers are unable to buy at the price at which they sold. So they sold yesterday and they're ready to buy today, but the price has gone up already, and so that's making it very difficult for dealers. There are also different types of buyers out in the market, as I'm sure you all know better than I, that there are dealers who are buying and selling and trying to fill orders for jewelers. Their added value is to find the right diamond at the right time for the right person. And then there are jewelers who are buying directly from suppliers and to fill the needs in their stores. And so what we're hearing anecdotally and seeing is that that jewelers are more cautious to buy at the moment than dealers. That there is a bit of a seasonal aspect to jewelers restocking of their inventory, and after the holiday season, they bought their goods in January, and now we're entering a slower period, and so from a demand point of view, there is some pullback from a segment of an important segment of buyers in the market that is maybe tempering the expectation for price increases, and especially if they are, and so if they're in a seasonally slightly quieter period in terms of their buying habits, they certainly would be hesitant to buy as the market is rising at such an impressive rate. And so buyers are that segment of buyers seems to be more cautious than before as we enter a seasonally slower period. And then from the other side of the market, suppliers, we are seeing that some suppliers are even hesitant to sell as they expect prices to go up further. We hear and we speak to people in the market where they are giving examples where, if they're getting an offer at a discount of 15%, 16%, 17%, then they're not accepting that because they expect prices to go up even more. So that's so it's almost like as my one colleague at Rapaport described it. It's like a Mexican standoff, and the last time I experienced that sort of sentiment in the market was in 2011. I remember at the March Hong Kong show, the suppliers came back from the show and described it exactly that way. That it was like a gunfight. People were making offers, and it was really a question of who would move first. And so there's this sort of standoff at the moment between suppliers who don't want to sell at these prices because they expect tomorrow to be higher, and buyers who are who may need the goods and can't find the goods as well, but are also growing a little cautious because of because it's becoming a slower period. And so we've been looking at these issues and trying to understand what's behind these increases for some time now. And I did my best to lay that out in the February Rapaport research report, and so I'm going to spend a bit of time looking at in this webinar to relay some of the thoughts that we have about the market and what I tried to lay out in the research report that was sent to subscribers. And of course, that research report also includes a lot of proprietary data that from RapNet that is available to subscribers. And so we're looking at four aspects of the market, speculation and bubble aside, that is influencing the price increases. And just to run through them before I go into them more detail, there's record retail sales, shifts in demand, the rough price increases that we've seen recently, and rough supply limitations that and so that's creating some shortages that are also lifting up. So as you see, it's from both the demand and the supply side of things, and that's what encourages the thought that the increases in prices are sustainable, because both aspects of the market are working in that direction, that there's good demand, there is a low supply, and those working together should support prices as they are. But again, that question comes back, should it be to this extent that we're seeing in 2022? And so looking at the retail market, we alluded to it earlier, that really 2021 was a fantastic year from a retail point of view. When we look at MasterCard Spending Pulse, who I think is a good, reliable source from our point of view, they continue to emphasize jewelry as a standout category at retail. And even in January 2022, we saw double-digit increases compared to last year, and also 2 years ago. So 20% up for jewelry year on year in January, and compared to 2020, which was also pre-pandemic, up 31%. We've seen these strong double digits, and even triple digit when it was compared to the depth of the pandemic. For jewelry sales. I would expect that these numbers will start to reduce as we compare to the strength of last year. And so if we can manage to continue to have growth, even at at sort of high single digits above inflation, let's say, then we're doing well, I think, in 2022. But I would expect that we will fall into the teens the teens in terms of percentage growth fairly soon. But still, this is an indication that retail sales are strong, and and it continues to do well. And we saw it from the major jewelers as well during the holiday season. Signet saw, I think it was about 30% growth for the November-December period. And that was a big jump compared to its historic holiday sales. And I think we can give credit to Signet for its turnaround that it's made, as we've spoken about before. But also, it's also an indication of consumer demand in the United States, and really the pandemic, I think, did reset the bar for the jewelry industry in terms of how consumers are viewing the product, and how consumers are shifting, almost naturally shifted to jewelry as the go-to product to express emotion and express appreciation for their loved ones in a difficult time such as was the pandemic. Another major is Lvmh, which bought out Tiffany a year ago. So 2021 was the first year that Tiffany & Co. was part of the Lvmh portfolio. But I have combined the sales of the two companies in previous years, and we see that there's still strong growth, certainly compared to 2020, but also it was in terms of jewelry sales of the combined companies, it was a record year in 2021, and that was not an exclusive experience for the higher end companies or the majors such as Lvmh and Signet. We got consistent reports of growth from jewelry sold in department stores and among the independents as well, and that does seem to be continuing, albeit it may, as I said, I would expect a lower pace or a lower rate of growth in 2022, but growth nevertheless, and growth that we would have dreamed of before the pandemic. So let's keep it going. In terms of again, I'm going through those four aspects that are driving the increase in polished in the polished market. So we've dealt with retail. The second is that shift in demand, and the big stories that are kind of the big pricing stories that are clouded in the general positive pricing story that we've seen in 2021 and 2022. Has been these sort of more niche, if you can call them niche products. I don't know if you can, but these segments of the market that have really taken off in the last year. And the first is the fancy shape market has really had an awakening in the last year. In 2022 and in the last few months, the eye clarity goods have shown the strongest increases amongst the different categories of clarity goods. So that's the second one. Thirdly, there's been a strong improvement in parcel goods, in small diamonds and larger diamonds that have not been certified, not been graded, and so that's a third one. And then fourthly, which I think might be normal for a time when the market is increasing as it is, that we're seeing a tighter gap in the between prices for none and faint or medium fluorescence. So usually within the trade, diamonds with no fluorescence sell at a premium, at a fairly strong premium of, I think it was 10 or 15% in some cases, over goods with fluorescence, and we're seeing that gap, that premium, reduce to some extent. And really, all these aspects, all these four examples, are have one thing in common, really, and that is that there's a shift towards a lower price point. And that's something that when we think about the retail market, that we would need to look into a bit more deeply. Is that coming from the retail market? Are consumers reducing, or are retailers, are consumers coming into retail stores with tighter budgets, and are retailers therefore reducing the quality of goods that they're selling to retailers, or perhaps consumers are coming in with the same budget, and retailers can fill that budget with cannot fill that budget with the same type of goods as they used to, so they are reducing the quality to get more bang for the buck. Anyway, just to go a bit deeper, or just to give a few examples of each one of those, or to show you some of the trends that we're seeing in the fancy shapes. And I think this was also sort of a D2H, IF. Sorry, I'm not. This could actually be just a general average of pairs and princess cuts on RapNet, but we've seen from the beginning of last year that there's been a very nice increase in across all sizes. That's 30 pointers of the blue, orange being the half carat, black being the 1 carat, and then the 3 carat as well. And again, we're seeing that sharper increase from around November, December time through to today, that continues to rise in the fancy shapes. Also, in terms of this is an example of eye clarity goods being having a stronger increase than VS and SI, and that shift towards the lower clarity. This is just one example, and it's really above 1.5 carat. We're not seeing the same sort of trend in the smaller in 1 carat or smaller goods. But certainly in the 1.5, 2 carat, 3 carats, this is an example of what we're seeing across the board in the 1.5 carat G color diamond. For VS clarity and SI clarities, we're seeing a similar sort of uptrend, but the black line, which is the eye clarity goods, is pretty sharp, and that gives us some indication of a spike in demand for those eye clarity goods. Again, another example, when we're looking at the non-certified diamonds and parcel goods, that's across all qualities, in all categories, we are, as you see in it's D2G VVS, HJ color VS2, KM color SI2. There's been a really sharp increase since around October time, certainly November, and definitely continuing through February, that we're seeing these sharp increases in price points for these parcel goods. So what is, I mean, particularly on the parcels, it's a question that and a trend that we identified from an editorial point of view. We looked into it already in December, and our news editor Joshua Friedman did some research looking into it, and we published at the end of December an article called titled "Small Diamonds Seeing Big Gains," and looking at what's behind those increases. And Joshua came, in speaking to people in the trade, came to three conclusions, or sort of general conclusions. The first is that there was a shift in manufacturing during the pandemic, that when the pandemic first started, the manufacturing was restricted. And so manufacturers, when they could manufacture, they focused on the larger goods, and that created some shortage of smaller diamonds in the market. The second is that the major source of small and lower value diamonds, being the Argyle mine in Australia, closed at the end of 2020, and so we're not seeing that influx of it was at its low point at the end of its life. It produced 10 million carats of diamonds, and it was predominantly the lower quality and smaller diamonds that it was feeding the market. So that's not on the market anymore, and again, maybe fueling a shortage of diamonds in the market. And then the third aspect was a shift in sort of taste and a rise in demand, in US demand for jewelry with these small diamonds in them, and that's again feeding into the price increases. I think that both those, the shortages and the increase in demand, is even more so now in 2022, particularly on the supply side. When we speak to dealers who deal in these smaller stones, they say it's very difficult to find diamonds that would, particularly if they're working with the major retailer on a program where they need a set, they need to replicate the jewelry en masse with the same quality of small goods. It's very difficult to fill those orders at the moment, and so there are those shortages. And then the fourth aspect that I would add now is that that rough prices for those small goods have also increased, and that's pushing manufacturers to raise their prices of polished, which is something that's affecting the whole market, but we'll get to that very shortly. Just a side note on the small goods, and this is something that others in the industry are asking the question as well from a journalistic point of view. I know that our friends at JCK have also recently had an article about this, and others as well, that the small diamonds are where synthetics was supposed to gain market share. That if that it was really in this category that the lab grown goods were going to eat into the natural diamond market, and if we're seeing at the moment the increases and the gains that in the natural small diamonds, it seems that is not happening. Even though we're also seeing increases in demand for synthetics, the fact that natural diamonds, natural small diamonds, are gaining at such a rate is an indication that prediction about synthetics is not coming true at the moment. And so that's just an observation and an interesting side point, and maybe worth a bit more research from our point of view. Why not? Maybe it's just not yet. Maybe there isn't the supply of lab grown to make that impact yet. But I'm speculating at this moment. But it's just something to put out there and something that we're starting to think about. So the third aspect of the market that is supporting pricing, the polished price increases, the increase in rough prices. As I said, if a manufacturer is buying rough, if his costs are rising, he's going to naturally increase his the cost of the price of his end product. But let's take a step back and look at the price trend of polished versus rough over the last year or two. And if we look at the time of the beginning of the pandemic, if you can see my mouse here, that the orange line is the 1 carat Rapi, and that's where the polished prices came down in that period of March, April 2020. And at the same time, the rough market froze. And so there was a different reaction between the rough and the polished markets to the pandemic, where polished trading was drastically reduced, and the price reduction reflected that. The rough market completely froze. And so that allowed the polished market to start to recover at an earlier time than the rough market. So we see that the Rapi for 1 carat started to trend upwards already in around May 2020, and it was only in around August or around July, August, that the rough market resumed, and that De Beers and Alrosa made their price corrections, and that was at a time when the polished prices were on the up. And so we had this period where manufacturers or dealers in the polished market were making a good profit out of the rough that they were buying, and so sometimes we're a bit quick maybe to point fingers at the mining companies to say, they are raising rough prices, and so that's causing polished prices to go up. But in this case, at the beginning of the recovery, really the polished price recovery did precede the rough price recovery, and so that gave some profit to the manufacturing sector, and also allowed an injection of liquidity to the market in the few months that followed. And so that increase continued, and then eventually the rough prices started to rise at the beginning of 2021. stabilized towards the end of 2020 and increased in 2021. And so the uptrend has kind of mirrored the polished prices at that time. But now we're at a point where there's tension in pricing. And so it's a question of whether of which came first, the chicken or the egg, the polished market or the rough market. And there is a feeling that the rough market is starting to overtake the polished market, or is now preceding its increases in pricing. Just to return to that story of the small diamonds, we are seeing the same trend in the rough, and so these are we've seen a spike in the cost of small rough that produces the smaller melee goods and smaller polish. And particularly since around September time, we've seen this sort of spike in pricing on the rough side of things. And this is our analysis of auction prices that we gather, and that's an important distinction, because the prices that we're seeing at De Beers and Alrosa are at a substantial discount at the moment to what we're seeing on the secondary market. The secondary market between dealer to dealer, and also on the auction circuit. So prices at auction are at a strong premium to the site boxes. In fact, it's not just a strong premium. The premium, people are talking about crazy premiums being 70%, 80% in some boxes, and that's something that we haven't seen in a long time, and that is raising red flags for people. So boxes are selling at crazy premiums on the secondary market and on the auction circuit, and that is fueling some expectation for increases again at the next site and De Beers site and Alrosa sale. But there's more going on in the secondary market than just that sort of speculative thing that there simply aren't enough goods coming to the secondary market. There are a number of reasons for that. The first is that let me take a step back. There are a lot of changes going on in the rough market and on the production side of things. The first is that the miners are driving pipeline efficiency. That they want to reduce the time that it takes for a diamond to move from mine to market, and they're doing their part in terms of reducing that time between processing and rough sale. We know that Alrosa put out a press release this last month saying that over the last 3 years, they've managed to shave off 15 to 25 days of the time lag between rough processing from at the mine to rough sale. And we know that De Beers is doing the same sort of work, and that's not a bad thing. That's a good thing. We want the market to be efficient, but it creates change in the market. And so the question then lies on the manufacturer and the polish supplier if they're doing the same thing, because if they're not reducing the time that it takes for manufacturing the rough to polish, then at some point they're going to be left again with a buildup of inventory in the long term. But we're nowhere near that at the moment, because there is actually a shortage in the market. Because the other thing that's happening in the rough sector is that the major miners have changed their supply policy. They And I think in line with that drive towards pipeline efficiency, they want more rough to be manufactured rather than to change hands between dealers. And so they've categorized, they being De Beers and Alrosa, have categorized their clients as into three categories, being manufacturers who manufacture rough to polish, retailers who are processing rough for their own in-house needs, and then dealers who buy rough and sell rough to the market. And a lot of that rough that's sold by dealers is relied upon by smaller manufacturers for their operations. And so if more goods are going to manufacturers, that means that there's less on the dealer market. And so we now understand partly what is driving the crazy prices on the secondary market for rough, is that there's less goods there's less goods available for trading, because more is being siphoned to manufacturers. Along that same theme, there is De Beers continues to encourage manufacturing in beneficiation centers. And so more goods are being manufactured in Botswana and Namibia, particularly. And that again means that less rough is going through trading in the traditional centers such as Belgium, Israel, etc. And also that less is being made available for those smaller cutters in India. And so it's changing the market structure, and there will be teething pains, certainly, that are at the moment looking like shortages in the rough market that's driving that or supporting that increase in pricing. And so a further result of that is that larger manufacturers who have liquidity from the recovery over the pandemic are able to push prices higher because they need the goods, and they're squeezing out the smaller manufacturer, and they're gaining market share as well. And so that's all leading to a supply shortage, in addition to the fact that there are fewer goods coming out of the ground, as we've discussed in previous years, and that brings us in previous webinars, and that brings us to the final point of those four aspects that are supporting or driving that increase in the polished market, and that is rough supply limitations. So when we look at global production, we've discussed in the past that the pandemic set a new lower bar for rough production, the number of carats that are coming out of the ground. In addition to the Argyle mine being closed, we see that in 2020, there was a reduction in volume, which is the blue bar graph, and then in 2021 we expect that our estimate is that it was around the same in terms of carats, but the value of production went up because prices went up essentially, and also there was that shift. Just prices went up essentially. We expect that in 2022. It'll be a similar story, that will still be around that same level of production, maybe a bit higher. These are rough estimates, and growth in value will be driven by price increases. But I want to look at this 2021 production level, because that doesn't tell the whole story of the rough market in 2021. Rather, this does. This is this gives an indication of how much rough actually came to the market, and because we see here that the mining companies managed to offload all of their inventory, as a matter of fact, of rough that they may have held. And so if mining a buildup of mining inventory is production minus sales volume, we see that the mining companies, and this is the combination of 6 major miners, being El Rosa, De Beers, Mountain Province, Gem Diamonds, Lucara, and Petra Diamonds, those companies combined sold about 17 million carats more than they produced. And so if we go back to this graph of production, that really we can add maybe 17 million to this bar graph over here, and that would push us to closer to 2019 levels. And so what it also tells us is that at the moment, if we're expecting production to be the same as last year, but we don't have that inventory left over at the mining level, it means that the mining companies have less rough that they are going to send to the market, and they're going to essentially sell what they produce, which is the way it should be. But that means that there's going to be less rough available to the market in 2022. We're already seeing that in January and February. We're seeing it on the secondary market, that it's another aspect that's influencing those shortages in the secondary market, and therefore those strong and crazy premiums. And we also saw it at the De Beers site in January, that the site was valued at around $60 million, which was the same as January last year. But if you consider that rough prices have increased by about 13% through 2021, and then there was an additional price increase at the January site, it just means that they're selling the same amount of goods for a higher price, and therefore this site in January, which is traditionally a large site, was a large site, but there wasn't as much carats that came to the volume of sales was lower than usual. And so the industry is being forced to make do with less at the moment, with less. And that's part, I think, of that drive towards efficiency, that it does need to make do with less. If you consider the mines that are producing at the moment, and it's not that the mining companies necessarily turned off the tap. Argyle is off the market. There's certain other mines that are reducing production. And so at the moment, we are looking at a rough supply shortage, particularly as demand increases for polished and for jewelry. So in a way, it's we're now in the scenario that the industry for decades sort of had that growth trajectory of flat supply in the long term, and the increase in demand driven by India and China. The India and China story is not necessarily the one that is driving growth at the moment. It's more an American story at the moment, but we are on that trajectory, and that should support prices in the long run. But in the short term, again, that leads that question. Those premiums on the secondary market, really, should it be that much? Those sharp increases in polished prices and rough prices that we've seen in 2022, should it be to that extent? Are the fundamentals there, or is there an emotional aspect or speculation that is feeding into that frenzy? And I do think that there is a speculative aspect to the pricing at the moment, and the price increases we've seen. So we do have to take a step back after looking at all those aspects of the market and express some caution. The first caution is in the rough market, that the changes in the rough market structure is leading to supply limitations, along with a stagnant production that we're seeing, and speculation seems to be driving up prices more than they should be going up. And then there's also caution on the polished side. If if the US consumer is the one that's been driving the increase, we've got to look at the context of that increase, that the pandemic brought with it stimulus to the American consumer. There was it was a period of strong saving, and then on the flip side, those aspects seem to be watered down now as we're seeing geopolitical tensions that may or may not have an impact on consumer confidence. Referring to Russia, Ukraine, for example, China, America, the list goes on. We're seeing that there's certainly are, there's volatility in the stock market. It's so far this year, it hasn't been the ride that we experienced last year in terms of the investor confidence on the stock market, and the wealth and the wealth building that came with it injects a bit of caution to the consumer space as well. And then the hot topic that everyone's talking about at the moment is the high inflation at 7% growth on a year-on-year basis, and the potential for interest rate hikes that increases the cost of borrowing money and has a direct impact on consumer confidence and willingness to spend on luxury items. The state of Chinese demand is something that we're also keeping an eye on. It's not clear yet. We haven't got good data out of China for the Chinese New Year, but there seems to be an element of caution, particularly amongst Chinese buyers who don't like to generally see these sort of incremental increases in pricing. And then again, we are entering now a period where there are going to be tough comparisons compared to last year, so we can't expect that same growth. So there is reason for caution and to maybe just calm our enthusiasm, curb our enthusiasm, if you will, and particularly looking at those price increases and at least asking the question: do they reflect the fundamentals of the market? Do they reflect the changes that are happening in the rough market, and do they reflect what the economic forces that may have an impact on the diamond industry? And again, I don't want to come across as pessimistic, because I think there is reason to be optimistic about the market. As I said, there are those fundamentals in place. There is that shortage of demand, and we are seeing growth in demand, in growth in retail sales, and that's reason for encouragement, particularly on the retail side. But I do think we need to take a step back and really be careful of entering a speculative environment. And so that leaves us with a dilemma for the manufacturer. What is and maybe we're not asking the right question. Maybe we're asking the question, we're asking what is driving the increase. Well, maybe it's who is driving the increases in the market. Because if we look at the diamond supply chain, the consumer buys from the retail jeweler, who buys from the jewelry wholesaler, or maybe they're the same person, who buys from the polish trade, who the polish dealer is buying from the manufacturer, or maybe they're the same person, who is buying rough from the trade, or maybe they're the same person, and the rough trade is buying from the mining sector. So that's the traditional way of looking at things. But let's take out the dealers for now, and also take out aspects such as memo, and look at and maybe simplify the diamond supply chain. So in that sense, it would be the consumer buys from the jeweler, who buys from the diamond manufacturer, who buys rough from the buys rough from the miner. And so if the consumer, as I alluded to earlier, if the consumer is coming in with a budget of $1,000, whatever it is, and the jeweler needs to fill that budget, but their costs have increased, then the manufacturer is left with so the question is, who is the manufacturer taking its cues from? Is the manufacturer taking its cues to increase polish prices from the demand side, from the jeweler who is selling more diamonds, or is it taking it from the miner because their costs of rough have increased, and so they need to increase their polish prices? And so the healthy state of the ideal state of the market would be for the manufacturer to take its cues from the jeweler, because the jeweler is the one who's if the manufacturer raises polish prices because there's more demand for their product, that's a good sign for the market. And I think for most of 2021, we were in that scenario, that the increases and those steady increases in polish prices were driven by good demand for product. But in the interim, towards the end of 2021, and I think now in 2022, we are seeing that the manufacturer, or let's say the polished supplier, is taking its cues from the rough market and from the mining company. The rough is increasing. It's increasing on the secondary market at exorbitant rates, and that is causing the polish, and that is I think a stronger element that's influencing polish prices at the moment. And so again, that's just a word of caution that we need to be aware of. So that's really the market at the moment, and I'd love to hear your thoughts and your if you have any questions for me. I do want to just touch very briefly on some themes that we're looking at in our Rapaport Information Services division when we look ahead at the at what editorially are going to be the strong stories in the market. We've identified three areas that are maybe somewhat surprising for one or two of them, but something that I think everyone needs to be aware of, because these are also influencing strong change in the market, and maybe in one case presenting some opportunity that we're not quite ready to understand yet. So we are hosting, together with our friends at Sarin Technologies, who these three themes came also through discussions with them. So Sarin and Rapaport are hosting a series of webinars in the coming months. The first one on the 1st of March is going to be tackle the topic of sustainability. The second one will be, which will be at the beginning of April, we'll look at the diamonds and the metaverse. And the third one will look at automate the impact of artificial intelligence and automation across the supply chain, and particularly in diamond grading. So I encourage everyone to join us for those. We've got some fantastic guests on each of the panels, and it should be make for some interesting viewing, and again, to encourage that conversation that we are having with you. So so that's the story, and thank you for listening. I'm sorry I went over, well, it's been an hour, but if you have any questions, I'll be happy to try and answer them, and I'd love to hear from you. I think the best place to find me, I think, is on LinkedIn as well. I'd love to connect with anyone and continue the conversation there. So let's see if we have any questions. Firstly, in the Q&A, I think there may have been some confusion on where to put the put the question, and so I'll start with the Q&A and then move to the chat. The first is, will this presentation be shared with participants afterwards? We will post the video on diamonds.net next week. And I think it is automatically sent to, a recording is sent to you if you missed it. So yes, it will be. Okay, what is the typical turnaround time of diamonds in India between being imported as rough and exported as polished? That's a really good question. I think it has been reduced. You know, in the last few years, technology plays a big role in manufacturing efficiency, and so I think, look, I'm guessing, but I think it's around 2 months. There is the aspect of also sending the goods for grading. We know that last year there was a backlog at the grading labs because of the pandemic and reduced staff and an influx of goods as well. And so it also depends on that, but I would say probably sitting at about 2 to 3 months now, and I think before it was probably at around 3 months. But I stand for correction. I don't have clear data on that. I need to look into it. Okay, so thank you for the presentation. It's my pleasure. I wanted to get your perspective on how long will the party last. Surely the current level of jewelry sales is not sustainable. Well, I'm glad that the question is focused on jewelry sales and not polished, because my question earlier was on the polished price increase, which people seem to think will continue through at least the first half of the year. The answer is how long is a piece of string? But because I don't know. At the moment, it seems that there is that the momentum continued in January, at least looking at those MasterCard figures. We have heard some positive feedback from retailers, although when they compare it to January last year, they're saying that it's not as strong. And I think there is at the back of everyone's mind the impact of inflation of those potentially higher interest rates. But for now, it seems that the momentum is there. I think the bigger question for me, because I think the US consumer is a stalwart and provides a real strong base for the industry. I think the bigger question would be on the Chinese consumer, and I think the closure of borders and the lack of Chinese tourist shoppers is also having an effect on the market. And so the sooner we can get back to that normalcy, I think that will be a bigger help to the industry and maybe take a bit of the responsibility off the shoulders of the American consumer. Anyway, so I mentioned briefly about retail trends from China, and that there is not yet good data about the Chinese New Year. But what retail trends are you aware of prior to that, say in 2021 as a whole, and in very early 2022 from China? It's a tough question to answer because I don't have the data, or I don't have good data. We get strong reports from the majors, from Chow Tai Fook, from Luke Fook, Chow Sang Sang, and the majors seem to have had a good year, particularly Chow Tai Fook, and they continue to expand into China, into the tier 4 or 5 cities, and so they're still seeing they're reporting very strong growth, but I think it's the rest of the market that leads a question, and it's also a question of what percentage of the growth is being driven by gold jewelry and which is being driven by gem sets or diamond jewelry. We know that gold jewelry is having a good time at the moment in China, and so it's the jury. I'm expecting to get reports from the major jewelers and also from government sources, which maybe you need to temper a little bit, but I'm expecting those reports in the coming weeks. So I'm sorry I can't give a more detailed answer for that. Okay, is there a strong future for lab-grown diamonds? Probably. That's my answer, probably, but that shouldn't be to the detriment of the natural diamond market, because I think that the markets have segmented, and we're seeing that in those smaller diamonds that are discussed, and I think that market segmentation is going to continue, and so. So I think there's no reason why, there's no reason why both the natural and lab grown can't grow in tandem and maybe even maybe even support each other. There is this kind of there's this feeling of that one threatens the other, that they're competing products. But we've definitely seen more natural diamond players across the spectrum, from mining, manufacturing, and retail, embracing lab grown. So the big question for us is, and we're looking at it editorially, are the ethics of how you sell lab grown diamonds, and the disclosures involved in the disclosures that we think are required to tell the consumer that the lab grown diamond they're buying will not hold value and will likely decline in value over time as supply increases, and it lacks that same sort of preciousness, to borrow from Stephen Lussier. It lacks that same preciousness as a natural diamond, which feeds into the natural diamond value. So it's becoming, the conversation has changed about lab grown diamonds, but there's a market there, and it's certainly, it's definitely gaining in popularity. Retailers carrying lab grown have reported a very good season, a good 2021 as well for those products, probably better even. Okay, so let's. I'm just going into the chat to see if there are any questions there. So any signs that show the consumer demands for stones with proven traceability information, the origin of the rough, is growing in demand. So that traceability story is an important one, and we for many years we asked the question: can a diamond that is responsibly sourced, or does a diamond that's responsibly sourced sell at a premium to one that cannot show that same provenance? And De Beers did an excellent insight report in I forget when it was last year. I think it was October, November last year, that showed that it did. And it's difficult to gauge the demand at the moment for that product. But what is certain is that the question of sustainability and ESG, the environmental, social, governance aspects of a company and their product is growing in importance. And so the traceability story fits into that narrative. It's not about the traceability. I mean, the traceability is an important aspect, but it's one aspect of the broader issue of sustainability and social and having a responsibly sourced product that you can present the customer. And so that's where that's where the conversation, that's where the industry is heading. And we are seeing some very, very big and important brands that are building collections around traceability, such as Butcheron, who's tied in with Saren, for example, to show traceability on a new bridal collection. And so it's one collection. But from what I'm understanding, and it's something we'll discuss in that sustainability webinar that I promote, is that there actually isn't enough supply for the brands to expand their traceability programs. And so the brands at least recognize that that the responsible sourcing story is an essential element of their brand and their story that they want to tell, and they want to expand that, but they can't at the moment because there isn't enough supply of traceable goods. And so that's where there's an opportunity for everyone else in the market to really jump on that bandwagon. Not only because there's a demand for it, but also because it's what needs to be done. Consumers, product needs to be responsibly sourced, and B, consumers want to know that it is responsibly sourced. So consumers may not necessarily be going into the store and asking, where is this diamond coming from? But they are having a conversation about ESG issues, environmental, social governance issues, and they want those assurances, especially from the brands. Okay, I'm going to take one more question if there is one. Let's see. Okay, I'm just going to. Okay, so again, just a quick, it's really a housekeeping question. When will we upload the recorded version? I'm hoping probably Monday, Tuesday, or let's say early next week. We should have it on diamonds.net, and then it does go out as an email blast through Zoom, I think, and so you should receive the recording. We don't make the PDF available, but the recording is available, so you can trace my graphs on your computer screens. Okay, so listen, thank you very much for spending time with me this afternoon or this morning for all of you in the US. I look forward to seeing you all soon. I know next week there's a big conference and a lot of events in Dubai. Unfortunately, I won't be able to make it, but my colleague Joshua will be there, so keep an eye out for him and say hello. And as I say, email me or reach out on social media if you have any questions. And either way, I'd love to connect. So thanks for your time. Thanks for listening, and best of luck for the coming months. It's a jungle out there, but it's a lot of fun for us. So God bless and stay safe. Thanks, everyone.